Hey guys, just wanted to record a quick video showing a Peloton trade that I put on today. It's a very typical 50-25 delta put spread, except usually I do those for about 45 days. Today I went in and did this for 2 days, and that's because Peloton has their earnings tomorrow after the bell, if I'm not mistaken. Obviously, today was a really bad day for Peloton. And it's horrible news with the treadmills being recalled. Um, and of course, people actually getting hurt and stuff with these things. So, kind of crazy day for them. But Peloton is, a name that I'm always interested in. My family has a Peloton. We use it. We like it. I can see their subscription model with all the other fitness stuff and just the potential growth for the company. So, anyways, it's just a name that I don't mind owning, anyways. And typically, I won't put on a put spread or sell put spreads on anything that I wouldn't mind owning, just in case that's how it ends up. Then I need to take 100 shares because I like to have that decision on a put spread that I put on. So, with all that said, what I did was I went in here and I'll explain kind of like my logic behind this trade in a few minutes, besides what I already said. But I went to what was then the 50 delta for this Friday's expiration, May 7th, and sold the 50 delta, which was 85. And then I bought the 25 delta, roughly, which is the 75 put. So you have a 10 point widespread, so $1,000 at play here, but you're receiving a credit, and the credit that I received was 387 bucks. So what is that? $613 potential loss, max loss, $387 max gain. So the theory behind this, and actually I think I have this in the analyze tab here. Yeah, so see the dates. I have this one of the profit loss at 5/6. So tomorrow, just so I could do some calculations. Then one at the expiration. So as you can see down here, you're looking at your profit loss on those dates. Other things held constant. If I go up and down on Peloton's price down here. So I think you're going to have a pretty massive move, most likely on earnings, or not a move at all because it already just got priced in today. Kind of the bad news, but I don't know. I mean, from what I can tell with all my friends and people who are buying Pelotons, you can't get one right now. They're just totally backed up with orders still. The lead times have gotten better, but it's not like it's you get one the same day kind of thing. I mean, you got to wait. They got a ton of orders still rolling in, all that subscription revenue. So I'm just kind of like betting that Peloton's still doing really good besides the treadmill issue. And what's going to happen here is it's probably going to go way up or way down, right? And if it stays the same, if it kind of like floats around, that's fine, no big deal. I'll make money on that because this is a put spread that's kind of at the money or almost at it. If it goes way down, let's just say if it goes way up, great. I just collect most of my credit. I'll probably close it on Friday. Let's say instead of getting $380, I get $200 because of the volatility crush that occurs after earnings. Um, if it goes up, and just the fact that it went up and there's the expiration. So now if it goes way down, there's a few things that can happen here. One, if it goes way, way down, then my short put, this 85 short put, could get exercised overnight. And so I could wake up on Friday morning with 100 shares of Peloton. And that's why typically I will not trade any put spreads on companies unless I just don't mind owning them, especially if I'm doing it short term like this, and especially on earnings. I just learned that a long time ago, where I woke up a couple mornings after trading earnings, and I owned stuff that I did not want to own, and it went down and down and down, and I'm like, oh, I'm just gonna have to take this loss because I don't want to own these shares. But with Peloton, I would probably take the shares wait for it to kind of drop and bottom and maybe dollar cost average down and buy some more shares and then probably start selling calls against it until it came back up. That way I get paid to kind of wait to sell it at a profit, or just kind of wait for it to bounce and then eventually sell it, kind of break even or whatever. Um, so that is a possibility that I could get exercised overnight because this is such a short term expiration. Um, more likely than not, though, if it goes down, I'll just wake up with a losing trade, right? And what I'll do at that point is I'll roll it out because most likely, yes, there's a volatility crush that occurs after earnings, but if it goes down substantially, then usually that volatility kind of sticks around. Yeah, some of it might crush away, but you're still left with a lot of it. So then I would go in here and I would take my 10-point wide put spread and I would keep the exact same strikes and I'd roll it out probably. I'd just kind of like fish around and see. So actually, if I go here, I probably can already. This is with the current volatility that it has, so it's going to be different math after earnings. But if I go to create a rolling trade, it's going to pop this up and it's going to give me an option of the date. It's automatically going to default to the next expiration date. And really, all rolling is, I used to be confused like it was some magical thing that people did when I first started trading options, but all rolling is closing the current trade and opening a new trade. So whether you do it in one transaction or not, sure, there might be fee differences and this or that, organization things in your account that may or may not make sense if you do it separate. But that's all you're doing is you're closing usually a losing trade, opening a new trade that's usually identical to the existing trade, but with a different expiration date further out in the future, just to basically buy yourself some more time. And usually you're trying to do that for an additional credit. So you're taking in more possible profit on this trade. You're buying yourself some more time. And usually I like to do that on the put side, not the call side, because you assume, all things uh, in the future kind of stay the same as it's been in the past, which, that's not always the case, that most good solid companies will go up in the future at some point, even if eventually they crash, right? So you're basically buying yourself more time on the put side, hoping that this stock will eventually recover. Um, and so I like to roll out at least like 2 or 3 weeks, usually about 30 days if possible. And I'm okay. Like, yes, you want to try to get a credit so you get an additional credit, but I'm okay too if I'm like paying $20 out of my $380 dollar potential profit on this trade to buy myself another month. That's okay with me. No problem. Um, so that's also one way it could go. And then another reason why I like to do put spreads on companies I don't mind owning. Let's say this goes way down here again, and I'm talking about a lot of worst case scenarios because I like to think that way. Like, what if, you know, the stuff hits the fan here and you're stuck with a really bad losing trade? Well, you can always just kind of close it out for the loss too, right? So the worst case scenario here is that I close out this trade and maybe I experience, all the way up to a 600 and something dollar loss, but more likely than not, like a 500 or $400 loss. Okay, life goes on for me. This is a very small percentage of my entire account. Um, but you could also, if it goes down, you could close out this long put here, the 75. If, like, let's say the price goes down to like 70 or even 75 or 60 or something crazy, then this 75 put's going to be worth a lot of money. So you could close that, keep the short put open, and then I could just assume the 100 shares of Peloton that I was ready to take anyways. So that's another way that I just love put spread because it gives you all these options, no pun intended, at the end of a trade if it's kind of gone against you. You can do all kinds of different things just depending on where you're at with your capital and all kinds of other stuff. So anyways, that's my Peloton earnings trade. Feel free to ask me questions in the comments below. Hope I tried to slow this video down a little bit and kind of like explain more of what I'm doing instead of just assuming you guys are, intermediate options traders or more advanced. And so, yeah, I hope that some of my explanations helped, and I'm happy to answer any questions that I can in the comments below. And remember, this is not trade advice. This is just an idea of mine and a trade of mine that I hope you can use for educational purposes and entertainment purposes only. All right, guys, thanks for watching.